Can you kind of elaborate on what other avenues there are out there for passive investors who are looking to invest into real estate-backed industry?
You have a sales job and you're getting paid like really well. You are actually lowering your return on your time by doing single family rentals, possibly even doing multifamily. You really have to keep track on what your return on your time is. You're going to actually reach financial freedom much faster by creating leverage.
Welcome back to another episode of Peak Profits. Today's guest is Whitney Elkins-Hutten, Director of Investor Education at PassiveInvesting.com, founder of ashwealth.com, and author of the #1 best-selling Money for Tomorrow, How to Build and Protect Generational Wealth, published by Bigger Pockets. With over $800 million in real estate holdings spanning multifamily, self-storage, and express car washes, Whitney is on a mission to help high-earning professionals and business owners protect, steward, and grow their wealth through tax-efficient, passive strategies. Whitney, welcome to the show. It's amazing to have you on.
Thank you so much for having me on.
Awesome. Well, Whitney, just before we jumped on, you said you've been doing this since 2002, and in the last 8 years or so, you feel like everybody is really starting to talk about it. So I'd love it if you could take us back all the way to the beginning on what really got you started on this investing journey and why you're so passionate about helping others ultimately protect and steward and grow their wealth.
Well, that is a very long story. I'll keep it compressed. So my role is the Director of Investor Education here at PassiveInvesting.com. And I'd like to say that I actually started off in the private equity space, but I didn't. I started off in 2002 as an accidental landlord. I bought a house with a significant other at the time. And, we're doing things a little out of order, get the house, fix it up, maybe get married. We'll see what life holds for us after that. Well, a month later, I was the money partner. I should clarify, he was bringing the sweat equity. And a month later, we were like, ooh, this is not going to work. Well, I had the house. Everything was under my name, the loan, I put all the money down. And so, clean break, but, I had a house. Well, I don't know what to do with it. I had no idea. I leaned on Home Depot. I got the Home Depot 1, 2, 3 book. I did a ton of Home Depot classes. My dad loved doing woodworking. He was like, oh, you can learn how to tile on your own there's an 11 a.m. class on Saturday. And I'm like, that's what I want to be doing on my Saturday. But it ended up being kind of fun. This house had psychedelic daisies painted all over walls, green shag carpet. I did things on this house I should not be doing at all. But sold the house 11 months later. During that time, I had been, needing to pay the bills. So I stuffed roommates into the property that didn't mind living in a construction zone. And so 11 months later, going like this, a little bit of relief. I have a $52,000 check, more money, almost as much money as I was making in my day job that had me traveling almost 70, 80 hours a week. And then I realized I didn't pay for any of my expenses the last few months. My roommates had been doing that. Oh, by the way, when I filed my taxes, that $52K was tax-free because of the 121 exclusion. I'm like, hold the boat. How many more times can I do this? So started doing more live-in flips than house hacks. Not everyone was rosy. Met my husband, so we're doing this together. And eventually he was like, Winnie, I don't want to move anymore. We need to do this with other properties. So we got scaled to a 40 single family rental portfolio. Started off in state, then eventually moved out of state so we could get cash flow. Then decided we needed to go bigger, a 52 unit apartment building, and then ran out of our money. So we decided to partner with 2 other partners. When I say me, with 2 other partners, and we grew a private equity company. And then, COVID happened. And that was a, really interesting inflection point for me of like, when is enough? Here I'm able to travel with my family. I'm able to work from home, 2 things I never thought I'd be able to do unless I fully retired and walked away from employment altogether. And so I've re-engineered my portfolio yet again during COVID. And, I just love teaching people how to take similar steps to what I did. But more importantly, learn from my lessons, because I had several hard lessons as an investor. I know there are so many investors out there that have gotten into passive real estate and they're like, this is for the birds. You promised me cash flow, or that nothing could ever go wrong. It's not a matter of if, it's a matter of when, and how prepared are you? And so, that is part of not only educating people on how does this whole investment work, but how do we create a fortified financial foundation for you to weather the deals when they go up, down, or sideways, or maybe it's the stock market.
Yeah, that's great stuff too. And it sounds like now, being in the business for 23 years, you have a vast amount of knowledge and, more importantly, I think, experience in the space that you've been through. I can imagine all types of different scenarios and situations, right? Where now you could help those that are just getting started to avoid those mistakes that you made, or I started in 2016. There's mistakes along the way that I made as well. So that's some of the more important parts of having a mentor, or joining a program that can help educate you and kind of shortcut those mistakes along the way. And that's great context. So you mentioned a 40 single family houses. Is that where you currently live? And did you primarily focus in Colorado to start, or was that in a different state?
Well, so put my first single family rental under contract on Christmas Eve.
Oh, wow.
One year. And I'm talking about one that was truly, I bought as a rental, not one to fix and flip, right? So got it under, I knew Christmas was a great time to buy because everybody else is looking the other way. They're doing other things. And I'm like, these houses are sitting on the market and these sellers need help. So put the house under contract. What I didn't know how to do was calculate cash flow. Guys, I'm an epidemiologist by training. We know statistics. Like, I know math, but like how to calculate cash flow just was not in my vocabulary. I knew how to calculate the equity return and all that, but monthly cash flow, what's that? Like, it broke even. And I'm like, oh, I can actually buy a property and it puts money in my pocket every month intentionally? Well, that's not going to happen where I live in Colorado. So that first property taught me a lot. That first true rental, I thought I was making $400 a month, but I was managing the property on my own. So if the toilet broke, not only do I have to pay the expense, but who has to go let the plumber in? Me. So it quickly became, an exercise to like leverage other people in order to get things done. And I got to the point where I did not want to go down to the property. I made it a point to, even though it was only 20 minutes away, I did not want to go there anymore. And I was like, wait a second. If I'm not going to the property anymore, what's the difference if I buy one here in Colorado or one out of state where the market and the numbers make far more sense? And so it took a little bit of convincing, of my spouse in order to get that done. He was not as excited as I was to go out of state. It's super funny. Like, by the time I've made a decision, I've already ruminated over it for like hours. When I presented to him, he was like, now he's got to start his process of rumination, right? So the first market we entered was Indianapolis. And actually, no, we closed on a property in Indianapolis and then also one in Kansas City the same day, because I got one under contract and like 2 days later, I got another one under contract. And I could do multiple at the same time because they were less expensive than buying something here. So when you ask like, where were these properties? Out of state, Indianapolis, various markets in Indianapolis, Kansas City. We've done some mountain properties here in Colorado, but haven't gotten too far away of being concentrated in those two areas.
That's amazing. And can you just share for those listeners that maybe don't know how to calculate cash flow, what that process looks like, Whitney? Again, you don't need to go into all of the details, but kind of the 50,000 foot or back of the napkin, as some people would call it, cash flow calculation.
Yeah, definitely. Okay, so somebody might laugh. They're like, Whitney, I can figure that out. Like, I took third grade math, right? It's simple subtraction, but you have to take into account, you got to make sure you're subtracting the right things. So your income, gross income for the month, the rent that you're bringing in. Now, you've already probably figured out that you need to back out your debt payment, your principal and interest. You probably figured out you got to back out your escrows, your taxes and insurance. Okay. Now, this is where people kind of go, what else do I need to back out? Well, do you have any expenses that you're paying on the property, like utilities, landscaping, snow removal, stuff like that? You got to back those things out. Okay. Now, this is the last piece, is your return on your time. Okay. We got to figure that in. And this is what I wasn't doing. I was like, I'm going to save myself money by managing this property myself. That's all fine and dandy as long as life's not happening to me, as long as my kiddo's not sick, as long as my husband hasn't broken his neck on a mountain bike, which happened, as long as my mom didn't pass away and I have to settle her estate, which happened. That's where I always encourage everybody, always figure in property management. Okay. Now, you may not want to do that right now, but always figure that into your calculation, because you don't know when life is going to happen. And you want to be able to move things over to property management like that, like overnight.
And what's a good rule of thumb from a property management standpoint that you've seen for single families? I know it can vary, but
like cost wise?
Yeah, generally percentage wise of like gross rent, right?
Yeah. So property management, I have a lot of love for them because they have two clients. They have the tenant, and then they also have to keep the investor happy. And they work on such slim margins. So I generally, for a great property manager, don't nickel and dime them, if they're falling somewhere between 8 to 10% gross rents. Now, what I do want to control are the turn fee, the renewal fee, construction fees, maintenance fees. Those are the things that I think are more negotiable when you're just, talking about property management. But just day to day, for every $100 that you're renting your property, it's $2 more between an 8% property manager and a 10% property manager. Where you're going to actually save costs is actually in those additional fees that get piled on.
Yeah, that's great info too for the listeners, and you kept it very well spoken to understand. I think for our listeners, a lot of our, I guess, avatar of listeners within this podcast would be high earning tech professionals or high earning sales professionals that are looking to explore options to invest into real estate. And now that first question comes about is, do I want to get into the active side, which is typically looked at as single family? And I see you shaking your head on the screen, right? It's like single family, one by one type of properties. And that's the way I started in 2016. And it took me just a couple years to realize that wasn't the path that I wanted to go either. And there's a couple reasons as to why, but I also think, to your point, the numbers don't make as much sense anymore from a cash flow standpoint. If you buy a house that's $300,000 and you're renting it for a couple $1,000s a month, how much are you truly pocketing when you back out all those expenses? And then you have something that goes wrong with the property and it comes out of your pocket, and that wipes out your cash flow for a year or two, right? And so you're doing all this work, and what is your time worth? And so once you start to realize that component of it, you start to look at the other side, which is the passive investing, or to partner with operators or partner into these commercial deals that could typically cash flow stronger, provide much less time and effort on your end, aside from the due diligence and ensuring that you're doing the right work on the front end from a partnership standpoint, and who you want to partner with and what deals look like. And so I guess that's a good leeway to take us into what you focus on today from the passive investing side, both at education and passiveinvesting.com, but also you're in other asset classes now, not single family, right? So can you elaborate a little bit? I know you do express car washes, you do debt funds. Can you kind of elaborate on what other avenues are out there for passive investors who are looking to invest into real estate backed industry?
Awesome. Well, I love the fact that you are identifying for your listeners. If you have a sales job and you're getting paid like really well, you are actually lowering your return on your time by doing single family rentals, possibly even doing multifamily. Depending on, you really have to keep track on what your return on your time is, right? If you have everybody has a higher and better use of their time, and we want to keep you in that higher and best use of your time. You're going to actually reach financial freedom much faster by creating leverage. Now, there's a whole reason. There's multiple emotional reasons why people don't lean into that leverage. Sometimes they have to go buy the single family rental, maybe do one or two, buy a small multifamily building before they feel comfortable going into a passive investment. They go kind of like you, Bryan. They're like, ooh, this was not for me. What am I doing here? That's fine. You got paid to get educated. Not many people can say that. And real estate tends to be fairly fairly forgiving if you invested in it the right way. Like if you are able to hold on to the property long enough, at some point in time, you're probably going to break even or make a little bit of money, even on a bad deal. Where people get nipped is if they're not able to hold.
Yep.
Right. That's really
Finance.
really it. If you're not able to hold for whatever reason. Now, where passive investing, I'll kind of approach this is from my inflection point. Here I was, this 40 single family rentals, 52 unit apartment building in partnership. I was doing in partnership at a private equity group that I was helping scale. All we're doing is multifamily. And I was like, you know what? I want exposure to other asset classes. What else is out there? I mean, everything under the sun. Pretty much if it's, if you can buy it, you can go into partnership on it. You can probably syndicate it. But popular things in commercial real estate are going to be like self-storage, hotels. We got into express car washes. We started, at passiveinvesting.com, we started looking at those in 2019 because we could see the compression in the cap rate happening on multifamily deals, meaning that the cash flow was going to get pretty thin on some of these deals. And so we were like, okay, our investors are chasing yield. They're still chasing yield today. This is more of a market where you buy the real estate and you wait, as opposed to buying cash flowing real estate that makes bukus of cash flow right now. So what are those businesses? Parking lots, problem there. Are self-driving cars coming around? Like more people are taking Ubers. Chris, you live in the middle of the city. Like, people take public transportation. Okay, what else? Laundromats. I really want to get into that because there's a lot of mechanicals to take care of, and you're getting tipped. You're not getting paid. Then we really landed on the express car washes as a unique opportunity because you can actually in the express car wash arena, you can wash $400 to $500 or 400 to 500 cars a day with just 2 to 3 full-time employees. And so it can be a heavy tech laden industry. I don't think people really realize that. You can optimize the heck out of that. But also we help our investors not just do equity, but help them to diversify their portfolio. And I think a lot of passive investors have a limited view of diversification. They're looking at all equity assets in different asset classes, different operators, different markets, different deals, and they go, I'm diversified. I used to think the same way, but it just takes, for me, it took COVID, right? All of a sudden, everybody stopped paying rent because of the eviction moratoriums, or the operators were hoarding cash because they didn't know if the tenants were going to pay rent, okay? And I'm like, whoa, wait a second. Who's still getting paid right now? The bank. The bank's still getting paid. How do I now put myself in the bank's position? That means I'm in the debt layer of the capital stack. I'm not in that high risk, high reward layer in the common equity position. I now need to start adding investments to my portfolio that are in the debt layers, senior debt positions. If I want to take more risk, now I can go in the mezzanine debt positions, promissory notes, maybe even unsecured debt, which is not my fave. I've lost money on that. Trust me, that's a hard conversation to have with your spouse. My first $100,000 loss was on an unsecured debt investment. It went well for the first 3 years until it didn't. So fortunately, my husband, I have an amazing husband. he was like, okay, did we make money? I'm like, yes, we did make money on this deal, but we also just lost. And then we can get into the preferred equity positions, but that's what we help our investors realize. They can create whatever type of portfolio they want with us, but we strongly encourage. It's something for the past 18 months, almost 2 years, has been talking about. Let's get your reserves met. Let's get you a liquidity position through debt layers. Then we can take the big risk on the equity positions, right? It's not either or. We can go into the whole strategy on like how you can build something like that and build both layers at the same time. But I look at people's investment portfolios all the time. And when I spin their portfolio and show them their risk tolerance, it's like 1% reserves, 2% liquidity, and then like 97% equity. And when they look at it like that, they're like, oh, I'm like, yeah.
It's funny you say that, Whitney, because I feel like debt funds have become increasingly popular. over the past kind of 18 months to 2 years, as you mentioned. Bryan and I are both personally invested in debt funds as well as equity deals, also as a form of diversification. I think one of the biggest things for people to understand what you've just shared there is, yes, there are levels of diversification between operators. There's levels of diversification between asset classes, whether that's car washes, multifamily. But also, I think what you've just shared, and a lot of people don't know this, that you can essentially also act as the bank with those debt positions. And when you speak to people and say, "Did you know you could also act as the bank?" Most people assume it's like, no, that's really not possible. But the reality of that is, it is very, very possible, and the returns are often better than those you would get with equity, but they are taxed differently, of course. So there are pros and cons to each. So with that being said, what would you share as some pros and cons for those listeners between equity and debt deals?
Well, okay, I don't want to say pros or cons because both deals play a different role in your portfolio. So they both belong, okay? I think it's like we have to, they're tools in a tool belt, and we have to use the right tool for what the goal that we're trying to achieve. Okay, so there's so many rabbit holes we can dive down here. Let's take the risk rabbit hole, and then don't let me lose sight of the tax rabbit hole. So the risk rabbit hole, just because I say it's a debt fund doesn't mean it's 100% risk-free. I was at a conference with some highly skilled passive investors, and they're showing me their debt fund positions. And I'm like, cool, you say that's a first position lien debt fund, meaning you're the bank, you're truly the bank. And you went into that deal because they told you, the operator told you, you could get your money back in 2 or 3 days. They were like, yeah, I wanted that. It's liquid. Ask the operator, do they have a line of credit on that debt fund? They were like, why? And I'm like, because you're no longer in first position, you're in second. You're now behind the bank, right? So even within debt funds, there's risk. Okay. So I have a whole video on passiveinvesting.com, DOT.com YouTube page. You can go there. You can check out all the education around debt funds. There's one titled The Good, the Bad, and the Ugly about debt funds. So there's still a lot of risk even within the debt fund environment. I think a lot of people are very aware of the risk in the equity, arena right now, right? Who's the operator? What's the market you're going in? What are the market challenges? What's supply and demand metrics? Like people that have been investing in equity are like, ooh, supply demand, like that's heavy right now. Like we're oversupplied in a lot of areas. And there's a lot of absorption still to happen in a lot of markets. Insurance cost, taxation cost, all those things have been going up. It's starting, we're recording this in November 2025. Some of those numbers are starting to stabilize. I actually got a tax rebate on some of my property in Colorado this year. I'm like, who does that? What market does that? Isn't that amazing? But here's another differentiation between debt and equity. When you go into an equity deal, you and I are partners on a deal. Okay. And I, as the operator, have to turn around a ship. And that does not happen overnight. It's probably going to take 3, 5, 7 years for me to reposition. And if I tell you 3, you need to plan for 5. If I tell you 5, please plan for 7. Okay. Because it always takes a little bit longer, unless we have some tailwinds behind us, which we don't right now. We don't have the tailwinds. Okay. In that case, yes, the timeline might shorten a little bit. But your investment's illiquid. Okay, we're partners. Okay, you can't come to me and say, I need my money back. You just don't give me that money to begin with, right? Let's use a different pot of money, right? Don't use your kid's college account or the money that you're saving for your kid's wedding or the money you need for a remodel in your house in 2 years. Now, what can we do with that money? Because I understand you as the investor. I'm right there with you. We can actually utilize debt funds possibly in a safe, risk-adjusted way and get, but we have to go into debt funds with a clear lens that we're going to get a lower rate of return. We're the bank. We're in the safest position. Low risk, lower reward. Can you go into a debt fund that has liquidity to it? Like in our Pick Real Estate Debt Fund, we don't tie people's money up. So meaning you can call me and say, hey, Whitney, I need my money back. Our PPM says we have 90 days to get it back to you, unless you're investing $1 million. And we can talk about that later, right? There might be something else we can do with that $1 million. So but what the mistake I see happen often is that investors chase yield. And so they go into a debt fund that's not matched with their goals that they're trying to achieve for that particular investment. They get starry-eyed. They're like, well, what if I lock this money up for 12 years or 3 years, not 12 years, sorry, 12 months or 3 years, and I get like an extra 2% return. Yeah, but now we've taken that liquid position and now made it illiquid, which is exactly the opposite of what we should be doing when we separate these tiers. So again, I lead our investors through an education around how to identify your true risk tolerance. I mean, I think that word gets thrown around a lot, like kind of like the word conservative. Your risk capacity, right? You might be willing to jump out of an airplane, with a decent parachute on your back, but what are the what ifs? Like, can your family survive without you? Like, should that parachute not open, right? So again, that's capacity. What is your capacity to take that risk? Okay, so if we move away from risk tolerance and risk capacity and the differentiation between debt and equity, and we talk about the taxation, this is another kind of mistake that I see, and I've done this too. I don't ever talk about a mistake, beat people up for a mistake if I probably haven't done it myself. So letting the tax tail wag the dog. I think this is a huge one. This is, I think, what stymies people going into equity investments all the time, because they feel like, I'm not tax optimized. We don't need every dollar in your portfolio to be optimized. We need it to do a job, and you have to identify those various jobs. And if we can't get the tax optimization with the dollar invested, maybe we can get it through a structure. What do I mean by that? So, if somebody invests in an equity deal, I like them. I'm not a financial advisor, but ideally, can you hold that cash, right? So you can get the depreciated benefits on your 1040. You can use that loss to offset income, maybe other passive income in your portfolio. Debt investments, if you need to optimize that, if you're super worried about taxes and you're not willing to pay the tax man, can you use a structure like a Roth IRA or a traditional IRA? In this case, it has to be self-directed in order to leverage the structure that the government has given us for retirement accounts. That's another way to keep things tax deferred or even tax exempt.
That was all.
That was a lot to unpack. So I'll just kind of like drop the
Yeah.
bomb and then we can go down.
I was just about to say that was all really well spoken, and now I can understand why you're the director of education, because all the concepts you're talking about, Chris and I are very like well educated on, and we talk about this stuff all every single week. But you're just the way you're explaining it, I feel like I'm back in a classroom setting. I'm like, she's explaining it in a way that's so easy to understand, and I hope like all our listeners are getting a ton of great advice from this, which I know they are, because we are. But this has been super helpful. So you mentioned that too, and when you talk about the tax perspective and the way you just broke it down and unpacked it all, it's so important to think about how you're leveraging and utilizing that capital, because so many people will look at a deck and chase IRR or chase a number before understanding, again, how long is that going to be locked up? The illiquidity, a 5-year projection could easily turn into 7 if you have to refinance and in 4 years because the market's not where it needs to be and the property's not quite where it needs to be, and you refinance it to another debt or another financing aspect, and you hold it for another 3 years, and people are like, oh, I thought this was a 4-year hold, right? There's a lot of components to that. And then the debt funds, right, will give you a little bit more flexibility, but they see 8, 9, 10% maybe that they're paying, and they're like, but I can get double in an equity deal, right? But there's pros and cons to that, which I think is super important, what you just outlined. And so when you look at someone's portfolio and have that initial conversation, what are some of the key aspects that people should be thinking about, right? If they have $100,000, $200,000 of liquidity, maybe they have solid financial foundation right now with 401ks doing well in their current job. They're making good money, but they, sales professionals often get large commission checks or large quarterly bonuses or yearly bonuses, right? Where now they have flush with cash. And so you start to think about some of these vehicles that you can put that money into. So what are some of the top questions, or maybe when you first get on a call with someone that you're trying to understand their portfolio today, but how they should be thinking about it?
Yeah, I'll give you kind of like the steps that I think about at a super high level. And when I'm working with an investor, these are questions that we sit with like for hours, maybe even days at a time. So one is, what is your 10-year vision? Where are you at today? What do you want to get done tomorrow, like in 10 years? Okay, because what you need from your portfolio now and what you needed to do in 10 years, it's like we might need to turn a ship, right? If you're in all equity in your 50 and you needed to kick off all cash flow in 10 years, that is really short timeline to exit a lot of equity deals, guys. 10 years is short. Okay. Yeah, you could push sell and buy on the stock market, but don't get me started on the stock market. Don't get me started on the Wall Street casino. Okay. So where do you need to be now? Where do you need to be in 10 years? Okay. Then we can start setting like little milestones, breaking down the goals along the way, like what needs to pivot. But that requires that you know every single asset in your portfolio. Most investors I know, they collect their K1s, but they don't have a complete balance sheet of all their investments by who the operator is, the market those investments in, the type of investment it is, the asset class it's in, and the risk level of the investment. And I'll just even put it in 3 tiers. Tier 1, it is cash sitting in the bank for a rainy day, meaning your car breaks down, you have to pay a health insurance deductible, your reserves, right? You lose a job, your reserves, you're not going to invest those, right? They're going to stay in a high yield savings account. Okay. 2, is it liquidity? Is it debt fund? I call it a predictable cash flow tier, like debt fund investments that you can get in and out of with relative ease. Now, there's kind of a 2A, 2B to that. Cash flow that I can liquidate immediately, and then cash flow that I can get at in like 24 months, right? Because my investors want to optimize a little bit. And then we get into tier 3 assets. Those are where all of our equities sit. Now there's controlled, meaning you own it and you make all the decisions on it. There's passive. Okay. We want to break them down in those 2 categories. Now, so we went through the questions to kind of ask ourselves, our vision, break down your portfolio, even in just those 3 basic categories, and see what the breakdown is. 9 times out of 10, the portfolio that somebody's looking at today does not match where they need to be in 10 years. Okay, so now we need to start picking off the ones that are going to exit. Okay, either we need to get out of them because of performance or operations or something's happening, or we get to get out of them because they're exiting in some form or fashion, and we can start turning the ship. Those 2 steps alone will help, okay, get somebody oriented. The third piece that I love walking our investors through is understanding your specific investor thesis. How many times do people listen to a podcast and go, "Oh, that's an amazing investment. I'm going to write a check to that." Or I saw this post on social media, or a post within a mastermind group or a public forum. They're like, "Oh, I'll check about that." Sit down and create your thesis first, right? Again, that vision's part of it, the risk part of it, tolerance is part of it, but like, how much money do you really want to allocate to any one operator, or in any one market, or in any one asset class, or any one investment tier? Okay, and create that plan ahead of time. And then before you write the check on any investment, go back and make sure that you haven't violated that thesis. I call it, with my daughter, I call it cool head thinking versus hot head thinking. We want you to make the decisions while you got a cool head, because when you are looking at a deal that you're really excited about it, now we got hot head thinking. We all want to think that we do run our due diligence tools and that we're making a completely logical decision. And that is completely not true. If you've read any book by Morgan Housel, Psychology of Money, or Same as Ever, case after case, you're just like, by the time you get to the end of those 2 books, you're just like, I'm an irrational being. I am making irrational decisions left and right. So following just those 3 steps can actually put us back in the driver's seat of making rational decisions, to where we kind of have cool investor A that is like, okay, this is how I want my portfolio to look. And then we got excited investor B who is like, but this deal is going to make me a lot of money, right? And now those 2 can have a conversation. The 2 sides of yourself can have a realistic conversation. It will keep you out of a lot of trouble, I promise.
Yeah, I think a few things that you mentioned there. Number one, investing is not a get rich quick scheme. Right? These things take years. You said 10 years is even a short time, right? And a lot of people look at that as a really, really long time. And steering a ship, you're absolutely right. These equity deals last 3, 5, 7 years. So one of those is almost that 10-year cycle. So if you're within those, getting out of those, or even investing in those, that money is no longer available to you for that period of time. So I think that's always really, really important for people to understand that this is not a get rich quick scheme. This really is a longer term. Whitney, there has been so much that you've shared in just a short time. I feel like we haven't even scratched the surface of what we maybe want to cover. We may have to ask you to come back on for a second episode, because there is a lot to unpack, not just about how people could invest, but ultimately how you talk about budgeting being dead, and all of the kind of rules that billionaires play by, that us regular folk, if you will, could also play by as well. So we would love to have you on to talk about that. But I do just want to say a huge thank you. Where can people get hold of you? Where can people come to you to have you look at their portfolio and tell them where all of that risk ultimately is, just how you've explained to us?
Yeah, absolutely. So if you're interested in passive investing, you can find me at passiveinvestingwithwhitney.com. If you're looking for more one-on-one help, you can reach out to me at ashwealth.com. And, if you're like, Chris T's, like, if you're like, wow, I really wanted to get into those, billionaire rules of investing, you can follow my book, Money for Tomorrow. You can snag it at amazon.com and, get jump started until we can get the second episode out to you.
Perfect. Well, thank you very much, Whitney. We really do appreciate it.
Was an awesome episode.
Thank you. This has been
Thanks
fun.
so much, Whitney, for coming on, and we'll talk to you again soon.